Welcome to The Explainer. We're diving into a new kind of energy war. See, targeted attacks on critical infrastructure in the Middle East, well, they're not just messing with supply lines anymore. They're threatening to completely break them, and that is sending massive shockwaves through the entire global economy. Let's get into it.
This one quote really captures the terrifying shift in this conflict. We've moved past talking about temporary disruptions. The new fear, the real fear, is the permanent destruction of the physical ability to produce and export energy. We're talking about taking critical assets offline for good.
Okay, so let's start right at the epicenter of the shock. These attacks on the world's most vital energy facilities. The whole strategy has changed. This is not about blocking a few shipping lanes anymore. It's about going for the jugular, destroying the production hubs themselves.
This is ground zero of the energy shock. Ras Laffan, it isn't just some regional facility. It's a linchpin of the global energy system. I mean, this place is massive, about a quarter of the size of New York City, and its well-being is directly connected to the economic stability of countries thousands of miles away.
To really wrap your head around the scale of this, just think about this number. That one facility, Ras Laffan, it's responsible for 20% of the entire global supply of liquefied natural gas. When 1/5 of a critical commodity is suddenly put at risk, believe me, the word crisis is not an exaggeration.
So, all this physical risk, it translated almost instantly into a financial shock. Because when supply is threatened this directly, markets do not hang around to see what happens next. They react. So let's look at exactly what that did to prices.
Yeah, the market's response was immediate and absolutely brutal. Brent crude, which is the global oil benchmark, it just surged right past $112 a barrel. And you have to understand, traders weren't just reacting to the damage that was already done. They were pricing in the terrifying risk of what could come next.
Now, this is really interesting. If you look at the growing price gap between the international Brent price and the U.S. crude price, it tells you exactly how the world is reading this crisis. The market is basically screaming that this supply destruction is a huge problem for Europe and for Asia, way more than it is for North America. This isn't a demand issue, this is a full-blown international supply emergency. And the shock didn't just stop with oil prices, not by a long shot. It sent these immediate tremors across global stock and bond markets as investors literally just ran for cover.
What we're seeing is a classic risk-off reaction. It's where investors dump riskier things like stocks and just flee to what they see as safety. So stock markets fell hard, especially in Asia, which of course relies so heavily on Middle East energy. And at the same time, investors started demanding higher interest payments or yields on government bonds to make up for the growing threat of inflation.
Now, this is crucial. The bond market is now signaling a massive risk of stagflation, that toxic mix of zero growth and high inflation. This violent flattening of the yield curve, as they call it, is really just the market's way of saying that this energy shock is going to choke off economic growth down the road, even while inflation stays stubbornly high today. It has some really nasty echoes of the oil shocks of the 1970s.
And all of this leaves central bankers, the supposed guardians of the global economy, in an incredibly difficult, you might even say an impossible position.
And you can see the split playing out in real time. On one side, you've got the U.S. Federal Reserve, and they're being really cautious, taking a wait-and-see approach. Their chair is basically saying it's too soon to know. But on the other side of the Atlantic, traders are practically forcing the Bank of England's hand, betting on a full interest rate hike to fight the inflation wave that's about to slam into the UK.
It really does create this perfect policy trap. So, step 1, the energy shock brings inflation roaring back. Step 2, those same high costs crush business and consumer confidence, so economic growth just starts to fade away. And that leads you to the final step, policy paralysis. I mean, what do? Do you raise interest rates to fight inflation and risk a massive recession? Or do you just wait and let inflation run wild? There are just no good options here.
So, for the biggest investors in the world, we're talking sovereign wealth funds that manage trillions of dollars, this entire environment is forcing a fundamental rethink of what risk even means anymore.
This insight from the manager of the world's largest sovereign wealth fund is just incredibly telling. He's pointing to two gigantic, simultaneous threats, a speculative tech bubble on one hand and a very real, very physical geopolitical crisis on the other. It's this dual threat that modern investment portfolios just aren't built to handle. It's a 1-2 punch they've never seen before.
And this just highlights the bizarre paradox we're living through right now. At the exact same moment that geopolitical risk is absolutely exploding, a company like Micron comes out and says it's spending over $25 billion on future AI infrastructure. You've got this huge split between long-term tech optimism and very immediate, very real short-term geopolitical fear.
So, all this brings us to the key question. Are these just temporary shocks, or is this the beginning of a whole new, much more volatile era of systemic risk? The fact that we're talking about the permanent destruction of physical assets, that suggests this isn't just a storm that's going to pass. It feels more like a permanent redrawing of the global risk map. So the final question for everyone, from investors to policymakers, is this: what happens when the unstoppable force of technological optimism meets the immovable object of geopolitical conflict?